I'm Mark from Cube Consultancy. We're an accountancy and consultancy business based in Harpenden.
Yeah, no, I mean, yeah, we started Cubed in what do we have? We say January 19 was our first invoice. So I'm
Yeah.
Richard, chartered accountant, started Cube with Mark in January 2019, having had a few years wandering around banks.
The difference between a limited company and a sole trader.
Yeah, fine. Well, sole trader is when you are an individual and you pay tax on all your income. Um, Such as, let's say a plumber, for example, they'll start off normally as a sole trader, they register with HMRC and they get a UTR, and then that is how they declare their tax.
Yeah, do you want me to de-jargon that for you?
Yeah,
A
yeah.
Yeah,
UTR being a
Yeah,
unique
go for it,
taxpayer reference,
yeah, yeah,
but
yeah,
yeah,
that's right.
because 60% plus of people in the UK are employed. So winding back one from the difference
Mm.
between self-employed and limited company, right? Most of us work for somebody else, and we're on someone's payroll, and those are people who are on PAYE. So most people aren't even aware of the tax they pay, the national insurance they pay, because it's taken from them for free by their employer as an unpaid tax collector for the government. So the majority of people don't have a choice. So they go to work, they get paid, and their taxes are taken from them before they even see it in their payslip. However, if you step outside of that and you try and do your own thing, and you're looking to be entrepreneurial, be self-employed, that's when the difference is relevant, isn't it?
Yeah, that's when we always advise people to kind of start off as a sole trader. If you're tempting the industry, often a limited company might be the right route, but if you're starting out, definitely in construction, a lot of people are self-employed
And plenty of
through
people will
UTR.
maintain their regular day job and
Yeah,
start their new business on the side.
yeah,
So, for example, maybe a quantity surveyor who's employed, but then he thinks maybe I'd be better off as a project manager. So he does a couple of experiments on the side. So at that point, he is being paid by his employer, and he has some new income, which is coming into a different bank account, and all of a sudden, he has two sources of income. And that then becomes the point where you should pick up the phone
mm.
to Cubes and for others and work out
trying
what's
to
in your best
change
interest.
trying to change their mentality from being someone on a payroll that knows their tax is taken care of and their take home is what they take home, to someone then declaring their income and having to pay the tax at the end of the year. It's a different mindset, for people to put money away.
So what's that transition from going from sole trader to a limited company then? Because you said you should go sole trader first. That's what you advise.
Yeah, depending on income. If your income is, or sales as well, under a certain level, about 60,000.
Yeah, there's a few
Yeah,
trigger points.
a few trigger
If
points.
you're selling more than 85,000 a year, you're going to bring VAT into play, and realistically, until you're earning 60,000 plus a year, there's no real benefit from taking on the extra responsibilities of having a limited company. So, hence the starting the journey as self-employed.
Often the perception as well. If you do start your business, sometimes you need to be giving the impression you are a limited company or a larger company than you are. So sometimes, often clients set up as a limited company so they can speak to the customers and go, right, we're a limited company, here we are. We are able to trade with you now rather than being a sole trader.
Right.
Mm.
And what are the you said that the benefits?
Well, but also don't forget, sometimes if you're looking to be self-employed and do your own thing, but you ultimately are chasing larger and larger clients, some of those clients that you're aspirational to serve may actually have a bias away from you as a sort of one-man band, and the fact that you are a limited company, you have limited after your name, you're even VAT registered ahead of your time, gives them an extra layer as the customer that you're a little bit more, of substance. Hence Mark's point there. But the main benefit of being a limited company once you get to a certain size is the ability to be more efficient with your tax planning, because you have choices. Now, a limited company is a distinct legal entity from a person. So I might be a director of a company, and the company sits over there as a separate person. So the two are distinct. The primary benefit that most people associate with limited companies is if it all goes wrong, your liability as a director of a company are limited to the amount of share capital you put in at the start. So most people are familiar with that. protection of being limited liability. You don't lose the lot. However, there's, effectively as a company and a director, you are a servant of that company. So there's these two distinct things. Now, after you've paid your taxes, after you've traded for a year, you end up with a profit before tax. You then pay corporation tax rather than paying income tax. And then if you still have a surplus left over, that's when the efficiency of tax planning can come to your aid, because you then have a genuine choice. The company can choose to distribute the profits after tax in whatever way the company sees fit. 9 times out of 10, the company is driven by that director or that pair of directors, and they make the choices as the officers of the company as to what the company does with its surplus.
Yeah, I always talk about having two hats. So as a company director and, the owner. So if you come down as an individual and come to see your accountant or take your accountant out for a coffee or whatever, you are technically doing that on behalf of the company. So you could recharge your mileage, 45p a mile, back to the company. The company owes you money for doing that. So anything you incur yourself on behalf of the company, you can recharge and get paid back.
I mean, if you're looking at headlines, obviously corporation tax, currently quite political, in the sense that Rishi wanted to increase it up to 25%, and Liz, I think as of 12 o'clock today, she's still Prime Minister, she wanted to lower it down to 19%. Now, that headline rate of corporation tax is obviously a lot lower than the highest marginal rate of income tax. So if you're a higher rate income tax payer at 45%, whereas a limited company is only subject to profits, at 19% currently, 25% maybe, somewhere in between typically. So, roughly you would pay about half of the tax that you'd pay as an individual, all things being equal.
Well, look at the guy I was just speaking to, literally a few minutes ago. Turnover, £100,000, and he'd been advised by a mate to say, I don't think the limited company's for me.
No.
When it clearly is. It couldn't be any more beneficial for someone. He should definitely be a limited company. He should have been from last year. He has now lost out on probably an additional £15,000 tax because of that decision.
And because everybody knows somebody who thinks they know and understands tax. A friend in a pub said, a mate who used to be an accountant, somebody who failed their exams, that is a very good example. That was literally in the last half hour.
Yeah, it was literally, I spoke to him. You speak to a client, you get a WhatsApp from someone and it says, someone recommended me to speak to you about your accounts. You don't know what that question is going to be whenever you speak to him. But this guy spoke to him, telling me he's a sole trader. So you go down the route of talking to them about taxes, then you hear £100,000 profit and you go...
What does he do this one?
Filming. He's a cameraman, ironically.
Well, is that when you're advised to say, okay, you're earning this much now, you need to become a limited company? That's your advisable decision?
Yeah, we would kind of advise on that. We always try to spend as much time speaking to clients as we can.
But what was also interesting, you also said, as I picked up on, was before we give you categoric advice, can we just take a quick run through of your bank account and see actually what's been going on? Because sometimes what people see as income or turnover might actually not be the same thing, and so they may have spent 20,000 on a van, for example, which isn't going to be relevant in an income tax situation initially.
Yeah.
So have a quick review first before you can give categoric advice, but there are a couple of rules.
Well, that's on a new client, but on your existing ones, when you do a sole trader set of accounts, you normally do it at the end of a year. When you're doing a limited company, you kind of keep on top of it, maybe monthly, quarterly, depending on what the client wants. So you're able to advise a bit more. But often with the sole trader, when we take them on board, we say, listen, tell us what's going on during the year. If there's a massive intern or upturn of income, or you're thinking of buying something, you've taken on staff, then we can advise.
Or a one-off contract. The income that I've had for the last 3 months is not representative of what I expect to do in the next 2 years, because that would be highly relevant to give proper advice.
So let's say someone starts a company and they get a big client. Let's say they have retainers. That's how they do retainers, right?
Yeah.
And I don't know. The first retainer is big, and then after 5 months they stop working with that client, and that's their main source. And then they bought, let's say they've gone from a sole trader to a limited company, and they stop working with that client. and then the money starts to drop. Well, you know, they're in a position where they have to look for more clients.
Yeah, look, you can always reverse out of a limited company. You can close that company down. But if you've had a year where you've had a big, influx of money, it's probably worth keeping it in for that year. You've definitely set it up, so you've had the benefit of that. Then you'll make a decision the next year. Now you can always wind that company down and keep it as dormant, and then put your income through as a sole trader. It really does. It depends on what you think's happening. That's when you definitely want to encourage your clients to just keep talking to you, just let you know what's going on. As soon as you know what's going on, you can best advise. But going in and out of a limited company, you can do it. However, you don't want to be striking off companies. So I'd always encourage to keep that company as a dormant company, pick it up whenever you want, use it for whatever you want going forward. You can always change the sector you work in, the type of business you do.
The cost to maintain a company for 12 months just trading water is probably 150 quid. Yes. So it's minimal in the longer term thing. Because you never know that a company with 5 or 6 years track record is always more desirable than one that started last Tuesday. Yeah. So you may have a down dip or a little upturn, but having a history of a limited company will always serve you in good stand. In fact, if you're trying to get loan facilities from banks, they very rarely will look at a new limited company until it's got 2 years filed accounts, which for most people means nearly 3 years of trading. But of course, most companies need that capital, those loan facilities, that working capital assistance in the early days. So it's a bit of a vicious circle. Without the 2 year set of accounts, you can't prove that you can afford the loans that you're looking for to expand the company.
Yeah, people when they think of having a limited company, they're daunted by it, thinking they've got to speak to an accountant. I spoke to you yesterday and said so many people think that accountants work for HMRC. They literally believe that that's how it kind of works. When, you work for your client, you help them with their tax planning, help them with filing accounts. But people are scared about the process of setting up a limited company, and it is relatively easy. I mean, when I think about when I first started, I probably had that as well. That it was quite daunting, or you thought of an older generation as having limited companies, but that isn't the case anymore. It's younger and younger. I got asked recently what's the age that you can have a limited company from, and I had to Google it. It was 16. We've set up a client now that has 16 years old that has a limited company, which, even when we first started Cube, I would never have thought that would have been possible. But the new younger generation, probably because of COVID as well, there were so many side hustles that were set up and side businesses and expanding into different areas, and like Richard said, second jobs. So now, they are setting up limited companies and they know the process of it, and there's so much information out there now. Yeah. I mean, me and Richard probably from different generations in learning, but I would have learnt on a piece of paper and T accounts and.
No, we both learned the same way, which was debits and credits.
Yeah.
Debits the one nearest the door, credits the one nearest the window. Yeah. It was real basics, but you didn't have the luxury of the 21st century and software that's available with a click or a press on an iPhone.
It had just started when I was.
Yeah, I mean,
finishing training.
Sage was the main player and mover in the 70s and 80s in the UK. And the move to automate bookkeeping away from literally ledgers. I mean, people talk about sales ledgers and purchase ledgers. That's because they were physically different books. Once upon a time, going back to Dickens' time, I guess, you would have the sales ledger in that room, you'd have the purchase ledger in that room, and you'd have the general ledger, the person who brought it all together, as a third department. Now, of course, with software and clicks and apps. QuickBooks initially, more recently Xero, you have the ability to produce a set of accounts at your fingertips. Yeah. The only unfortunate thing about that is with the ease of use and the quickness of preparation, you lose a layer of understanding and you lose a layer of distinction between what is an asset and what is a liability, what is income, what is expenditure. And that is why most people feel a little bit more comfortable to involve an accountant who does their annual returns or does their VAT quarterlies for them, because below the surface of the icons on your iPhone does actually sit some quite complicated rules, processes and procedures, which only the people as old as me actually, can do with a pencil and a rubber. You probably did it
Well,
with
no, I remember
with a
we used
pen.
to have these ETBs, which was these huge long sheets of journals that you just used to fill in. So, I could look at a set of accounts and know the transactions behind it, where the trainees are kind of coming through now, and because you click a button, it's automatically done. I compare that but the software has also meant that us as accountants, as Cube Consultancy, you've got to offer more. The bookkeeping, I compare it to a flat pack at IKEA, right? Everyone thinks they're a carpenter because they can put it together. But, doing an actual set of carpentry or putting a table together or making it
Give them a hammer and some nails and they're fucked.
is a bit different. So, as an accountant now, the bookkeeping's done because an owner just thinks they can click on a button and set up rules and they understand it. But you now have to add more. You now need to explain, seasonality of sales and why things have happened. The relation between costs, where costs should be in a balance sheet, where they should be in a P&L. There's lots of stuff, but it's made accountants better. But in terms of the training
Some of
coming
them.
through,
Some of them.
some of them. The other thing we're seeing, especially with the sole traders, is we talk about a man in a pub doing it. It is often a man in a pub that's doing these guys self-assessments because they can get them a rebate or they can do this or reduce that. But there's no liability. They have no protection for you. We spoke yesterday about what is chartered accountants, and you're governed by ICAW. There's a standard there. If we fuck up, we mess up, we have to be accountable to them.
Yeah, that's the Institute of Chartered Accountants of England and Wales. The hardest, most difficult qualifications in the accountancy profession, but we would be biased. But the reality is that we're governed, as Mark said, by a lot of rules, one of which is you are not allowed to take on clients that represent more than a certain percentage of your turnover, because you have an unnatural exposure to that client's whims, and it might may give you conflicts of interest. Likewise, we need to carry professional indemnity insurance. So we advise you on your taxes, and you end up with a bill from HMRC of £2 million because we've screwed up. You can then sue us, and we have the legal protection and the insurance protection which ensures you gets paid out. So and the reason we are governed by the ICW as well is because we adhere to certain standards. We have a obligation for what they call CPE, continued professional education. We have to keep ourselves up to date of all relevant taxation changes, be it corporate, be it individual, be it even as the world moves forward, and we're now moving forward into cryptocurrency. There's an obligation and an expectation that if you were to come to us, we'd better advise you on what your weekend's cryptocurrency trading has created in terms of a liability. Well, you can start from the basic that all humans are greedy and self-obsessed and don't want to pay more tax than they have to. So if you earn £1,000, most people would rather keep the majority of that £1,000 for themselves and their family, rather than donate too much to the government. By seeing an accountant, seeing professionally trained people, you will actually be in a better position to keep the majority of your hard-earned income for yourself. And most people start from that position. Sole traders would not want to be paying 50% of what they earn over to the taxman.
Yeah, I always say that you should at least cover your accountancy fees in savings and keeping them just, correct.
If you're going to pay £1,000 to an accountant, there should be a reason for doing it rather than just keeping your nose clean. We would like to think, that an average tax return is a relatively straightforward thing to complete online for your average person with one source of income who doesn't do an awful lot. However, as you add layers of complexity, if you start to invest in plant and machinery, if you start to look into innovative ways to expand your business, and you start touching on uncertainty, and you start looking at some of the grants and the research and development assistance that's available from the government. Not everybody sees the government in friendly terms. We always tend to say, well, don't forget that whilst they're looking for their pound of flesh, there's also a lot of opportunities out there. HMRC and the politicians generally are trying to help people start new businesses, expand new businesses, grow the economy so that they can actually have more money to spend, and so society can benefit generally. Without entrepreneurs, without people starting new businesses, we're not going to go very far anytime soon, are we?
But doing videos like this and freebies and education is for us trying to show that, it's friendly accountants, approachable accountants, ones that you can ask questions. People are often think that it's a stupid question. I always say, listen, there is no such thing. Just ask whatever you want. When you're completely new to it, you've got so many questions. Speaking to a business owner that started, and you tell them, look, in a year's time, I'm telling you, you'll be an expert. You'll go into a shop and go, right, is that a business expense? And you'll just know. It feels alien to them, day one. But it does get there.
Well, also don't forget, you touched on earlier, QuickBooks and Xero and the softwares that are available and your online banking apps and everything gives you the information as soon as you want it right here, right now. What that's meant for accountants is that you can actually dispense with the 14-column paper, the analysis, having to add things up on a calculator. The production has moved from the majority of what accountants do to the minority. So now we might spend 5% or less of our day actually producing or adding things up or taking them away, which is good for both ourselves and also the clients, because you can actually spend most of the time on that analysis and saying, well, how can we help your business grow? What does the business actually need to move forward? And so the enablement through technology of bookkeeping as a dark art which is done in the background means that you have more time to think about expansion and opportunity. And that is really where you should get the most bang for your buck from your accountant. And if you're not, as Mark touched on before, if you're not recovering at least a couple of times your fees you're paying out, then why should you do it?
It's huge.
And don't forget, it is a professional relationship. It's like, most people, when they get in trouble with the law, they'll go and see their lawyer, and they know that there is a client confidentiality arrangement there, which is they are legally trained to give you the best advice to present yourself in the court in the best way you can. It's the same with an accountant. It's a partnership. There is such a thing as client confidentiality amongst accountants and clients. And it's what you could do is this: you present choices and you don't shovel their affairs in such a way to maximise how much the taxman takes.
The amount of clients that come up with a good idea, especially younger people, right? They come up with a good idea and they just go for it, hit the ground running, start making money, and then they know about tax. They know about it in the background. It's a niggling point. Maybe their parents are going on to them about it. There's lots, but they know it's coming, and then they get themselves so worked up and almost fear it, and then finally they speak to an accountant. For me, I'd much rather have a chat at the beginning, even before the ideas come out. If you've got an idea, I'd rather speak to you about it and how you go about setting it up, because it doesn't need to be daunting. The system's set up, HMRC is set up, the government website set up to enable it to be quite easy. Now, an accountant adds value and adds that arm over the shoulder, and this is what we can need to do, and that general support. But I'll just definitely encourage people to come forward and speak to an accountant as early as possible. Just makes it easier on them and us, and tax planning.
Cuba friendly.
Yeah, it's Cuba friendly. We've got lots of youngsters here working. Everyone's friendly, and they know kind of more or less all businesses. We don't specialise in anything. We just we know how businesses work. One or all of us, or has worked on the same sector or different sectors, so we kind of know.
Anybody could walk in our door, and there will be a reference point somewhere within Cube that has touched on something relatively similar in the past.
Crypto, we had to learn.
Yeah, crypto we had to learn because crypto didn't exist 20 years ago.
Yeah.
So there are very few things that come out of the cloud like that. And are genuinely new. Most things are variations on a theme you've seen before. If you're a footballer, if you're a boxer, if you're a retailer, if you're a solicitor, if you're a property investor.
The influencer market it's a bit new. It combines lots of different avenues of different types of businesses, but it is a little bit new. And that's a prime example of where clients have just hit the market and just gone for it.
But it's just sort of a cloud-based form of PR ultimately. You pay someone a fee to do something and promote a product or themselves. It's kind of the same. Someone's getting paid and someone's spending money.
Well, it's because you kind of go out on your own. It's a prime example of a sole trader, right? You have an idea or you build a following, and you then all of a sudden it comes up with opportunities where you can monetize that and start getting paid. Where it might be promoting some clothes or doing shout outs to people or whatever it is, you know. Yeah, you essentially covered it there. It is a PR company. Now, that could ramp up really quick. You know,
That's the difference. When you're dealing with social media,
Yeah.
you know, once upon a time, selling a lot of small things would take time. So, you know, most typically, you know, you'd have a manufacturing business, and the first year it sells 10,000 of whatever it's making, the next year 20,000, the next year 30. You know, growth is largely predictable. When you come to social media and, you know, the cloud-based economies, those are, you know, very binary. They're either hit or miss. And something can go from earning you 10 quid a week to £1 million a month within 3 months. And that's the difference. It's the speed of change, and therefore it renders the use of your accountant even more important, especially as you start to see that growth. Because there's no point, it's much easier to advise ahead of you making £1 million this year than it is after the event, because you may have missed some opportunities. The growth curve is a lot steeper.
Well, prime example for a limited company on that as well, right? Let's say, for example, you start out and you get your following and something comes, you know, you're getting some cash in as a sole trader. Now something happens, you promote something, right? And that turns out to be fraud, right? Let's say crypto or, you know, poison someone. You know, you could be sued. That's you being sued as an individual. You know, that's you. That could be your business completely wiped out. Where if you're a limited company, technically it's the limited company that's being sued. So you can walk away from it. You know, you can start again. Where as a sole trader, they are coming for you personally. So that's a prime example of when you need to speak to an accountant and say, right, I'm earning this much now. Is it the right time to get a limited company? Is it the right time tax-wise? Is it the right time protection-wise?
And once you go through that 50,
Yeah.
60, 70,000 pounds of income a year, it's normally the answer is yes, you're better off.
But exposure to the public really does open you up to, you know, legal action. You know, I mean, how many times are you hearing people being sued? You know, it's common. It's getting more Americanized as as it goes over here. So you need to be aware.
Scary.
Yeah, you need to be aware of it, because it could literally take your house. You know, if you're not protected.
In that space,
I've got Courtney Black. She's a client of ours. So we've seen her business grow. I mean, that's massively grown since we first met her. And she's been able to go into other avenues, you know, clothing, things like that, fitness. So she was a fitness app. Yeah, she's got loads of different activities going on. But again, that was a business built during COVID. You know, she was able to adapt really quickly from being an app to work in a gym to working from home. You know, she built a massive following. She's got books and all sorts. So we've got that. We've got a couple of other little influencers that are building up. We've got a couple of sports people. We've got some of the boxers as well. Daniel Dubois is a boxing client of ours. I mean, he's got some great fights coming up. You know, he's probably going to have social media following. That's probably going to be another revenue stream for him as well.
And that's a different sort of growth. It's like, you know, when you're talking about an app and a follower and an influencer, that goes from 10 to 100 to 1,000 to 1 million very, very fast. When you're dealing with someone like a boxer, it's like nothing, 3 million. Nothing, 4 million. You know, so it's a very different profile, and there's a different set of advices that you can give. Another one that springs to mind is when you have an author. So you'll have an author who will be given some money as an advance against, you know, a three book deal. Now those 3 books may not be on the shelves for 2 or 3 years, but the income has appeared in their bank account today. So what are the opportunities? What are the choices? What do they have to register? What do they have to disclose? So there's another example. You know, it's to do with the shape of growth. It's to do with the timing of revenues a lot of the time, and importantly, when you've got large chunks of revenue coming in, it's to what extent can you reduce the exposure of those large peaks to the taxman.
Yeah, and it's also someone that's worked with clients in that industry, you know, because we've been able to see how, you know, online businesses have been able to develop into other things. You can see the choices, you can see more opportunities for them, you can see planning, you know, for example, which staff should be on a payroll for different companies, when you should start taking on staff. There's lots of things you can advise.
But don't forget also, accountants see a lot of mistakes that others have made.
Yeah.
So you may be coming to your accountant as an individual, and as far as you're concerned, it's just you. But when you come to a chartered accountant or a business professional, we have over 1,000 experiences behind us. So the chances are, if there's a mistake that you might be about to make, we'll probably spot it before you do.
Launching a product too early. Yeah, I mean, not with we've currently been working on a project, and it's taken 6 months of Gantt charts and all sorts of, but we've looked at that and we've seen that was actually worthwhile. Where we've had a few clients that have literally just gone, right, bang, jump in, and they haven't got it right.
Whoops.
Yeah. I mean, me as well. Even I've learned that. I would definitely. I mean, Cube would start. We just jumped in, but projects, you do learn to just slow it down, get it right. Because if you don't get it right at the beginning, you can come into some serious, especially if it's going to be a public facing company. You want to make sure that everything works, it just flows, you've tested it properly, because if you don't, you might lose that initial client base that comes to you.
Yeah, you probably make better decisions generally if you involve your accountant, because they will have that wealth of background knowledge and experience.
We're practically counsellors here.
Yeah, you're unpaid psychotherapists a lot of the time. We actually, when we moved here, we were thinking of getting a couch so that we could offer that service full time, but it never came to be.
I mean, that comes to your decision making as well. I mean, you get 12,500, around 12,500 tax free, and then you're on 20% up to just over 50,000. So that when we talk about that trigger point of going to a limited company, if it's over 50,000, you're paying 40% tax here. It's 40% from 50 to 150,000, and then you're on 45%, and you lose your personal allowance. So that point of when you start paying 40% as opposed to 19%, well, probably going to be 25% corporation tax, that's a trigger point. So I speak to people, this is a perfect time of year now to get an update from your self-employed people. You say, well, what's your earnings so far? Because they've now got from now until March, to get to a certain amount. So it might be the right time to get in a limited company around now. Start looking. So often October time, I'll do a little ring round. When I reach out for them for their information for last year, you normally say, right, well, how's this year looking? Because you have to pay an amount on account, and I always ask, does that seem reasonable? Sometimes you've had a big year last year and they're asking for £5,000 on account, but you might not need that cash flow wise, or you might not need it because you haven't earned as much. So we can start planning. I mean, one of the main things we speak about is allowable expenses and what you can kind of put through. So you've got things like your phones and business travel.
Well, also don't forget that you'll know this yourself. When you were starting or thinking about it, there was an initial phase before you started. There was a phase during you were starting, and you were just getting going. And then there's probably at the moment, and all through those periods, you've been spending money. You've probably been spending money out of your savings, or you've just been spending it on a taxi here, or a laptop there, or an advert that you've put in the local newspaper, whatever. There's all these expenditures that initially you forget about. And when we encourage people to start a limited company, you say, don't forget that company that you've started, you probably started a year ago, 18 months ago. All that money you've invested to get the company to where it is today, that company owes you that back. So spending, yeah, but the company now owes it back to you, which again gives you another opportunity to be efficient when it comes to your personal tax situation. Because you can draw all that money you've invested to get you to where you are, you can draw out more or less tax-free, because there is no tax to pay at that point, typically.
Well, and the less profit, the less tax. You only pay tax on your profits. So you've got your sales, everyone knows your sales, and then it's what expenses you can offset against that to reduce your tax, and that's kind of the key.
So if you're saying that the less profit,
the
more the less tax you pay, why would somebody not spend most of it on expenses? So why would someone choose to keep a lot of money in the bank
Yeah, but the more money you keep in that company, it makes it more valuable.
Yeah.
You might be looking to borrow money. That company might be looking to buy an office or get finance on anything.
If you've been trading for 5 years and you've got £8.50 in the bank, and you go to your bank and say, "Can you lend me £500,000 for phase 2 or phase 3?" They're going to go, "What?" They're
Yeah.
going to look at affordability, and the fact that you haven't shown a record of growth and sustainable growth, and by that they typically take it to mean asset growth,
Yeah.
i.e., the balance sheet of your company has increased in size. What does that mean? It means the sum of the money in the bank plus the things that you use in the business, like your camera or your van or your tools, plus the money that your customers owe you. Those are your assets. So over time, a successful company will grow. All of those things will grow and move up. Now, at the end of a year, you may have £50,000 cash in the bank, but it's the company's decision, as controlled by you as a director of that company, what to do with that money. It's called a discretionary distribution. And you may choose to pay yourself through the form of a dividend. You may choose instead to invest it in a new camera or a new motor vehicle. You may instead choose to invest it in a huge social media marketing campaign because you think the time is right now. You've got that critical mass. You've reached the point where if you put another 50 grand into social media, that might come back 10 times, 100 times. So, you need to build up reserves, and reserves typically, most people understand to be cash in the bank, so that you can, when those opportunities present themselves, you can act, right? Spending isn't linear. You don't spend £10, £10 every single day. It tends to be more lumpy than that. Most businesses see an opportunity, they have a choice, they decide to invest or they decide not to invest. So your cash flow is very lumpy, very cyclical. Well, you have a choice, right? I mean, if you just take that one example of as a car, right? You may or may not need that car operational within your business, but you have two choices. You can either fund it yourself and claim back the running costs of that car from the company, or the company can own it and cover all the expenditure of that vehicle, leaving you effectively, out of the loop.
But it could be a benefit in kind for you.
And then you might have a tax liability to find later because you've had the use of that company vehicle. So it's a bit of a balancing act, really. What do? We don't. We at the moment we choose not to have company vehicles. We have our own cars, and if we go to see a client in Essex or one down on the south coast, or go to the airport, we charge the mileage and the costs of using our personal assets on behalf of company business. So at the moment, we choose to go that way. But for other people, especially those that are using the vehicles day in, day out, particularly tradesmen.
Vans is different. It's
very
much more
different.
much more tax efficient to do it that way. Cars through a company, electric cars, they're given loads of tax breaks, but normal cars, it's often not beneficial. It's often a lot better to recharge you the cost.
So what is an asset that you would suggest to go for personal, not for your own company?
I think a motor vehicle. I think a car.
Car.
In the business that you're in, for example, there is no real massive benefit, and it will probably end up costing you more in personal tax to put a company car through the business.
Yeah, I would definitely do that. Yeah. Things like cameras and stuff like that, put it all through the business. Cameras would probably qualify for super tax.
Yeah, you're probably
plant and machinery.
Yeah,
you get 130%. So you get 100% and then you get additional 30% on top as a benefit.
So you may have spent £1,000 on that camera, but you will have a £1,300 deduction against your profit.
Yeah.
So you've only shelled out £1,000 in cash, but you've got a tax benefit of £1,300 because for certain types of assets, and by assets we mean things that you use to generate revenue in your business, you're getting a bigger tax back for having made that investment. So going back to your strange accountant who said don't spend anything, don't take any money out, you can see why that would be a great reason to take money out, because you're actually going to get more back in tax benefit than it's actually cost you in cash. And those things you'll only know if you're having that conversation with your friendly, what do we call them, client relationship managers or something, at Cubes. We don't call them accountants because that's a bit too hard.
Yeah, it's changed.
We're a lot more touchy-feely. Was it relationship manager or client?
What do you call it, sorry?
Client relationship manager, I think, is the new term.
Yeah.
There's been
accountant sounds like me in a suit.
Yeah.
Whereas a relationship manager is all sexy and exciting. But
Apparently.
ultimately, we are genuinely trying to encourage all of our clients to phone inwards, and we're trying to encourage all of our staff to phone outwards, because it's only with free and frank conversation that you'll actually be in a position to know that you're making the best decisions. The worst decision you make is not making any decision. Right, that's the worst thing you can possibly do. Is to decide not to do something, because that's just potential opportunity missed time and time again. My mum would say, you never make bad decisions. They're always the right decision at the time. They just look silly after the event. So, but not doing something, you'll always regret. At least if you do something, you can always repair the damage potentially if it goes against you, and you can also count the cash if it goes for you. Different methods you can be paid. You can be paid a salary.
Yeah, salary is what everyone's kind of used to. As a director of a company, like an owner-managed business, which is you're the director and the shareholder, you'd normally have a salary for a small amount, which will take care of your personal allowance. So you get a pay slip for like £1,000 a month, something like that, and then the rest will be a dividend, and you get £2,000 tax-free, and then the rest you pay income tax on at a lower rate as well. So it's much more beneficial to be paid that way. Yeah.
Don't forget, just so in case people aren't aware, everybody, the same way you have a tax allowance, personal tax allowance, I think everybody pretty much knows you get £12,500 tax free, and this year they levelled it up so that that also applies to national insurance.
Yeah.
So everybody doesn't pay national insurance till it used to be like £9,500. Now it's the same. So you only pay national insurance above that level. You only pay PAY or income tax above that level. What people don't necessarily know is that everybody has a tax-free allowance of £2,000 per annum. So if you are self-employed and you happen to be in a limited company and you're a salary of £12,500, that's not exposed to taxation, you can then pay yourself a £2,000 dividend, and there'll be zero tax on that dividend. So you've now got £14,500 that has been not taxed. If you decide to pay yourself a £20,000 dividend, assuming your company has made enough profit to make that, then you won't be paying 45% on that dividend, because different rules apply to dividends as they grow in size. It used to be far more beneficial to pay yourself a dividend. That differential has been over time eroded, but it's still marginal. But it is now marginal once you go above 100,000. But 2,000 is 2,000, right?
Is that like one time thing?
No, it's per annum.
Per year.
annum.
Really?
Yeah, per year.
So you could literally go to your bank, take 2,000 out, call it a dividend, provided you're making a profit. If a dividend is a choice, right? A dividend is a declared dividend, and it's paid equally to all shareholders. Now, most businesses are just owned by one person, or husband and wife, or what have you. So if you declare a £10,000 dividend and there's two shareholders of 50% each of those will be paid 5,000, because you have to make a dividend across all shareholders equally. Now, most small owner-managed businesses they're the single shareholder, so the dividend is their income. But for sure, every year, 2,000, subject to you making profits that warrant that, is available for tax. But remember that you have to make a profit after tax of 2,000 to be able to pay yourself a 2,000 dividend.
A dividend is how you take funds out of a limited company as a shareholder. It's how you're paid. Yeah, I mean, you've got corporation tax, which is how limited companies are taxed. 19% as it stands today. It's going to increase. Then you've got income tax, which is how us as individuals are taxed. That's on the tax brackets that we spoke about. That's 20%, 40%, 45%. And
National insurance?
National insurance as well.
Because everybody who is in employment also pays national insurance. It's taken out of your wages at source. For those of you running a limited company, you also have to, as an employer, you have to pay national insurance. So there is employers' national insurance, which is another tax, which is the tax you pay for the privilege of creating employment. It's a bit naughty, that one.
VAT is probably the one most people are scared about. It's because it's checked each quarter, and there was loads of advertising for making tax digital, which and I think from this month, from the beginning of November actually, every company has to be on Making Tax Digital, which means that you all need to be on accounting software like Xero or Sage or QuickBooks, where HMRC could look at every transaction.
Yeah, that's what Making Tax Digital means.
Yeah,
it means the taxman being able to see every single transaction in your business. And if you're an individual, that could mean anything in your bank account. If you're a limited company, it mean anything that's gone through that company. And if you're doing VAT returns, it means everything, every bit of VAT you've claimed back, and making sure that every sale you've made has had VAT added. Because remember, VAT is a sales tax which is basically collected by the owner of the company and paid across to the government. So you're an unpaid tax collector.
Yeah, back in the day when the investigations were going on, you would literally have a letter from HMRC that would just say, right, we're going to come to the office and do a site visit. And then you'd have to get all the paperwork. But now, because they've got the detail, they'll literally go, right, they'll investigate it from afar and say, right, give us this transaction, top 5 purchases, sales, and then they still might come.
The investigation or site visit was show us the top 6 VAT inputs, i.e. the cost that you've claimed VAT back on, and explain why you didn't charge VAT on these sales. And the answer was because that was a new house, so it was 0 rated. And the reason we claimed that back was because we bought that pub from that company and they charged VAT on it. So the reason the investigation was preempted was because a company that had been typically reclaiming £5,000 to £10,000 a month in VAT all of a sudden reclaimed £95,000. So that acted as a trigger somewhere in the bowels of HMRC to say, aha, before we pay this amount out, we're going to go and ask a few questions. And they did, but as I said, there was nothing to see, and it just meant that instead of getting the refund within 10 days, it took 52 days.
It's a prime example of having an accountant. If you have an agent, then we are your agent. We speak to HMRC on your behalf. Otherwise, HMRC is going to come around to you where you are, and you're going to have to deal with that investigation. Often now the process is that we would speak to HMRC first. They would come here, and the client doesn't need to be here. Clients are petrified of HMRC call, HMRC investigation, anything to do with them. So to be that barrier and be able to speak to them.
And it is helpful because if you've dealt with VAT before, you are mindful as you speak to an HMRC VAT inspector of where their question's coming from. So the reason they're asking that question is because they suspect they may be able to find some income that you haven't attached VAT to, which you should have done. But because you're dealing with this day in, day out, you're kind of like 1 or 2 steps alongside or ahead of the taxman.
That even comes to when you're reviewing someone's VAT return before we file it. Yeah. We kind of review it. I always review it thinking of myself in front of a tax officer, and that's how you've really got to do it, because if you put in a cost through, could you, which you might have to, explain that to a taxman, and I always go on that basis. So when we review, because obviously we don't do the manual plugging in of numbers, but we always review the VAT before it goes, you'll look like that. I look at it as a VAT investigator, and that's how you got to kind of look.
And what was actually quite funny about the one I just mentioned was we actually said to the client on that occasion, this is your largest VAT reclaim you've done in 3 years of trading. It might be sensible to split that reclaim over 2 periods, but they chose not to, and then they got picked up for an investigation.
Well, I remember back in the day, investigations were, when I was training, they were quite scary. Remember the one I told you about when I was at a meeting and it was £7,000 claim, and then the client, I was only young, I was a trainee, and the client said, where are you off to now? And he said, I'm just going to go and see my boat. And HMRC said, all right, how'd you pay for the boat? And he left with 28 grand tax bill. So just by him boasting and talking like that, it resulted in HMRC finding some additional taxes.
Your boring accountant will never brag on your behalf.
Yeah,
they'll never tell the taxman voluntarily about their Range Rover and their yacht and their villa in the south of France. They'll only answer that if directly asked. Does your client have a villa in the south of France?
28 grand from 7?
Yeah.
Wow.
Because he investigated what you'd paid fuel for. It was actually for the boat, which was private. Mooring costs, when you delved in more. Engine repairs.
It wasn't rent, it was a private
As
expense.
soon as you looked at the engine repairs, I was actually for a boat.
Oh, and by the
Not for
way,
one of your
you
trucks.
should have paid that 2 years ago, so we're going to put
Yeah.
a 50% fine on top, plus a bit of interest, and
That was
bosh.
Boat's not an expense.
No, because it was his item. He was a delivery man. He wasn't delivering stuff on boats.
You don't do a lot of delivery, do you, on a yacht?
No. So yeah,
Not in central London.
If you live in Greece, you just go from island to island.
the tax officer was actually literally packing his bag. We were all standing up to say goodbye, and he said that, and he opened the books up again, and we were down there for another hour and a half. It was the first one. I was only about, I don't know, maybe 20 years old, so it really was an eye opener for me. And I remember the senior partner going, what were you playing at?" You know. So yeah,
And also, VAT is an incredibly boring topic to talk about, but it's also probably the most scary thing that most clients are wary of, and with due cause, because the amount of legislation, the amount of guidance notes, and the volumes that are written by the taxman on what is and isn't acceptable in certain types of businesses is huge and immense. If you go to PricewaterhouseCoopers, they probably have 30 or 40 partners whose speciality is just VAT, and one of them will probably have a speciality of VAT just in hospitality, because there is literally volumes and volumes and volumes written, which is another reason to go to your accountant.
Yeah, I mean, there's so many changes, especially with Brexit or even the influencer market, things like that. You deliver your service through the screen, but it all depends where that screen is. So you might be delivering it to someone in America, but because it's where it's actually delivered, that's where the VAT is treated, and that's where the tax is accounted for.
And so, given the cloud, nobody can say nobody taxes the cloud. Right? There is no such thing as a tax haven called the cloud. Therefore, you have to come up with an approximation or a method or a way of deciding what elements of sales are taxable and which aren't, and coming up with a method that will be acceptable to the tax authorities. So you might say, if we can identify our customers who are in the Netherlands and France and the UK and have those as rough percentages and charge on that basis, that will be an acceptable way of moving forward.
You've got to be able to explain that. I mean, for prime example, someone might be delivering a service through the phone, and that person is registered with Stripe for America, but they might be living in the UK. You can only go on the information you've got, so you treat that as a US citizen, and there's no VAT. So, as long as you can back it up and explain. I mean, I've spent so much time speaking to HMRC about VAT and different rules, and because they've got to adapt. This cloud-based TVs, social media, crypto.
Yeah, and a lot of tax rules and regulation comes out of court verdicts.
Yeah.
So a lot of taxation legislation is built up based on real case examples where there was uncertainty, where they could tell that in those circumstances VAT would apply, and those VAT wouldn't. This looks somewhere in the middle. Let's take it to court, and they have a ruling that decides that it should have been, and then that becomes another volume, another page, and another chapter on VAT in that particular segment. I mean, there are some sectors where the VAT treatment is not absolute. Not everything is black and white. Like, pet food and the treatment of animal feed has got dozens of pages written on it, and we have clients, none of whom those pages apply to. So we've come up with the best method, and we're going to move it forward on this basis. Reached out on several occasions to HMRC and said, look, is there someone there who can give us specific advice? No, there is nobody who specialises in that area. So you have to move forward on a best effort.
Think about the construction. For new build, that wall there might be taxed at 5%, but this wall 0. It is literally wall by wall on new builds. So there's lots of, again, whenever you're looking at things like this, you definitely need an accountant in your corner that you can just ask questions for, and make sure you have everything in place. If you're saying it's a new build, make sure you got a certificate, because your subcontractor is going to need that. Anyone that bills you won't be charging VAT, but their accounting goes down the line, so it needs to be all
and there was a VAT, they call it desktop review at the moment rather than inspection, that was done last year, and there were a few errors in there, but because me, the accountant, was having a conversation with the taxman, and he would say, well, why have you done that? And I say, well, I've done that on the basis that pipe work was part of that environmentally friendly air conditioning unit, and therefore we thought that those costs would be treated in the same way. And you go, well, not really. And then so you're having a reason why you disagree, and so rather than it becoming a big issue, they say, well, tell you what, just correct that one, and moving forward, treat it like that. And then you don't get any fines, you don't get any interest, and you come to an arrangement because at least you've shown why you've done something. And that was actually quite a good example.
Well, that's the difference. I mean, imagine
dealing with the client, they probably would have said one or two things which they may have been unwise to say, and they might then have gone back 18 months and said, well, in that case, you can pay it here, here, and they might have ended up with a much bigger. I think the difference was 3,000. Had they gone back, it could have been 30,000. You know.
Yeah, I mean, the whole world is more accessible now. We've got loads of international clients or companies that trade with America. I was in America last week, started a week over there. Richard was in Borneo. No clients.
Not yet.
Not yet. But yeah, you need to be able to know how that tax is treated, whether the overall company is in the UK or if it's in America or however it's owned. There's another rule where you've got a limited company or a company in America, LLC, but if it's centrally managed here in the UK, it's deemed to be a UK company. So we need to advise clients on that and where board minutes should take place. If you should have some staff in the US, there's lots of different things. Now that you're learning on that, when I had my audit experience, I worked a little bit with US companies, but you are learning, and Brexit has definitely increased how much knowledge you need to know about international. We've got loads more guys that are trying to work that worked with European companies, so they are encouraged now, or they're starting to set up Irish companies for that element of their business. Now we've had to learn pretty quick with that. We've got some partners over in Ireland, but you are learning all the time. But because of the COVID and international, I mean, COVID definitely changed how we get clients, because you normally have to go to a client and go to their site, and you can only really work on a maybe 30-mile radius. Now you've got clients all over the world. Like we said, it didn't really matter, and you can have a Zoom call with someone up in Scotland where you could pick them up as a client, because the accounting systems allow remote accounting. You could be a complete outsourced finance team for a company in Scotland. So that's very easy.
The answer to the question is that we have a lot of clients that do a lot of business outside of the UK. However, the majority of our clients' income is ostensibly still inside the UK, but as an individual paying tax in the UK and being a tax citizen of the UK, you potentially can be taxed on your income from all around the world. So to the extent you bring money back to the UK as a UK taxpayer, they will expect to have a percentage of everything you've brought home. And that's kind of like rule 101. To the extent you bring money back as a UK taxpayer, they want their share.
Well, I mean, because of Richard's knowledge, we don't turn work away because of that international aspect. Be it a subsidiary of another company over here, be it they're completely over there. We do some analysis work for US companies. We just don't turn it down because we know we can work on it.
It's not limited in America, is it?
There's several different types.
There's a few. You've got through companies, and
most people will know the word Inc. incorporated as being the equivalent of LTD or limited. There's a few extra complications in America, like LLC.
LLC is another one. I mean, if you've got a subsidiary, you'd probably go LLC over there. They have companies that, what would you call them? I guess like holding companies over here, but it literally transfers money through, so it might receive the funds, but it goes straight through to another 2 or 3 companies underneath.
What's a holding company?
A holding company might be Cubed Group.
So the Cubed Group might have Cubed Racing, Cubed Consultancy, Cubed Tax Planning, and Cubed Overseas Investments Limited, all with common ownership, the holding company at the top.
Is that linked in like sister companies?
Sister companies are kind of subsidiaries, really.
Yeah. So if you have a company at the top which has 4 subsidiaries, each of those 4 subsidiaries is brother or sister to each other, but they all have common ownership. So they're all subsidiaries of the holding company, but they are kind of associated with each other.
So when you've got a holding company, so be it Cubed Group, and then that will have subsidiaries, which is Cube Consultancy, Cube Racing, Cube Tax Planning, and them companies will be sister companies of each other.
The subsidiary has to own a percentage, 51% of the.
Yeah, well,
Common ownership is.
We don't have this very often, right? A parent with 3 or 4 subsidiaries. If there is more than a certain percentage holding of the subsidiaries by the parent, that parent company has to produce accounts which are called consolidated accounts, which involves the income and expenses of all of the subsidiaries, and roll it up and produce a picture as if the 5 were the same thing. Now, whether or not you consolidate the results of a subsidiary up depends on how many, what percentage of shares the parent owns of the subsidiary.
Complicated accounts.
Yeah, and effectively, if you own 70% of a company, that means 30% is owned by somebody else. Mm-hmm. That 30% owned by somebody else outside of the group is called a minority interest, and you have to report that separately.
And what's the benefit of the subsidiaries rather than just?
Well, most often it tends to be operational.
Yeah.
For example, I'm doing some refinancing work at the moment for a group that is effectively a cash and carry business, but it has an export business, it has an online web wholesaling business, it has a physical distribution business, and it has come and buy out of our warehouse business. So it has 4 different distinct businesses, and for some of those it chooses to operate in different companies so that it can see the profitability of each individually, but ultimately they have common ownership. So they look at them up here, but they measure them down there because each one is run by a different manager or director.
Right.
But he might, choose to sell off one of them subsidiaries as well. So
that
would be
benefit.
Yeah, that would be a cost alone. So let's say it is the cash and carry bit. They could individually value that company or that subsidiary and sell that one off, and then keep the others in the group. Yeah. So when you've got individual companies, they would still be owned by individuals, so they stand alone as companies. Where they're part of a group, they need to be owned by a holding company.
Well, the other thing about that is another reason for having separate operating companies would be because the nature of each beast is materially different to one another. And Mark's point should be reiterated, which is you may choose at some future point to sell one of those businesses. Now, if you are a wholesale, long-established cash and carry business, when you sell that business will be valued on one basis. If you've got an internet-based, high repeat business, web delivery service, that will be valued on a completely different basis. So you may choose to have them for that very reason, because you'll get a higher valuation on a business that is seen as more techy, more fin, more future than one that is more traditional. Yeah. So that's another reason to have them, because if you're going to thinking of carving them out, you'll get a better multiplier when you come to value it or sell it.
Yeah.
Well, we've done it different ways in a sense that we currently have 6 trainee accountants in the firm, and each of them has had a different journey. And in fact, me and Mark are different in one sense, because Mark always wanted to be an accountant, whereas I wanted to be an astronaut. And I failed and he succeeded. So I actually went to university and decided relatively late on that I fancied doing something in finance. Mark was sort of knew that from a bit of an earlier age, so he went sort of straight into the profession, and that, and it's just the comparison between ourselves shows there is a number of ways of getting into accountancy should you choose. We have 2 of our 6 trainees who did degrees in business, accounting and finance, and they've joined on a 3-year fast track program to become chartered accountants in 3 years.
They get exemptions from the professional exams.
Because their course at Liverpool University or Brunel University or whatever they were have been vetted, approved and reviewed by the institute, and they've said if you do that degree we will give you 5 of your 15 exams for free, because we believe the course is of sufficient standard and the relevant information is learnt so that you won't have to do that exam and that exam. So 2 of our guys have got, there's 15 exams to be chartered accountant if you go that route, and I think both of them had 6 exemptions, so they've only got to take 9 exams. That doesn't mean they can do all 9 exams by Christmas and become chartered accountants, because it's not just about exams, it's about practical experience. And with the chartered accountancy membership comes a 3-year training contract, and the purpose of that is to make sure that over that 3 years you have relevant practical experience in taxation, in audit, in accountancy, in corporate finance, in bookkeeping, in law.
They're tough exams. Yeah, I mean, I did the school leaver, so then I went in, I guess it'd be like an apprenticeship now. I worked for a company called McIntyre Hudson, who are they're quite well up, or quite high in the top 100. Yeah. And I did the training that way, which meant more exams. I did AAT and then went on to the chartered. And they were tough, they were really hard exams.
And at the moment in the UK, there's 3 main accountancy bodies, which is the one we keep bragging about, which is the ACA, or Chartered Accountancy, which we're both members of. You also have the AAT, which Mark touched on there, which is the Association of Accounting Technicians, which is almost like an apprenticeship bottom entry feeder school. And then you have this third one, which is ACCA, which I think is Certified something Accountancy. It's kind of like a hybrid. It's designed more for people within large organisations.
It's quite international, that.
Yeah, it's more of an international business focused qualification. So you've got AAT, ACA and ACCA, and we have people here doing all 3 sets of exams. If you leave school at 16, 17 and go the AAT route, you can still become chartered by 25, 24, 25.
I think it's about 4.5 years.
Yeah, so you can get there just as quickly. In terms of advice, if you know you want to be an accountant or be a finance professional, the sooner you start, the sooner you finish. If you don't know, do something that you're interested in at university.
That year I had, or maybe it was longer, maybe it was a couple, on top of the graduates. You didn't really think you was learning that much, but when you look at it and they came in completely novice, you did actually learn quite a lot. You were way more advanced. I mean, you weren't as good as exams, and you still had to do some more of the older exams and then chartered, but you knew a lot more practicalities of being an accountant. So.
Well, that guy there you just heard the ring in the background, he currently works for an aerospace engineering company in Luton, and he is qualified accountant, and he works within a large corporation, and he is a financial controller who is charged with looking after and controlling the financial aspects of one business unit within a huge global business, but that's the only thing he knows. And so he'll be phoning there to talk about another business, which, although he's passed his exams and he's a qualified accountant, he doesn't know the answer to. And that's the difference. If you're trained to be international and within this type of business, you'll be very, very good for that company, but you won't necessarily be able to go and walk down the pub and advise somebody on their VAT or their tax returns.
They concentrate on the management decisions for a business. So they might look at sales for the last quarter, where they're coming from, analyse that. They might look at credit control. Are they collecting the debtors quick enough? Working capital, that's how much money you have in the bank. So you tend to slow down paying your suppliers and try and speed up how much you collect off your debtors, so you've got more money for investment into other things or paying wages, So that's how they're kind of judged on how smooth the functionality of the accounting team is. We do the statutory accounts, so when you see things filed at Companies House, so them guys will prepare accounts, they'll do the bookkeeping, they'll get it to a level of a trial balance, it's called, and then we'll come in and turn that into statutory accounts, review it. You might audit it, depending on the levels of income.
Yeah, and we just touched on the different types of exams you can do. All of those paths to accounting greatness have a number of exams, and they have sort of, when it comes to accounting, they talk about management accounting and they talk about financial accounting. Management accounting is the accounting you do inside your business to help you manage your business better. Financial accounting is the information you have to prepare and disclose to the world, and it is a representation of your company as it looks to the outside world. So everybody who's qualifying out there is doing management accounting, which looks internally and tries to improve the business, and financial accounting, which is you have to tell the world what you're doing. And those are two very distinct things: outward looking and inward focus.
I mean, I would always encourage to kind of do the qualifications in a practice, but that's just my preference. Now, often when you're in the bigger firms, you probably went through as well, you do the qualification, then there's an influx of calls from recruitment agents, and you'll often go into it, we call it industry. So you go from practice into industry, and a lot of people will leave and become a management accountant. We actually do some accounts, post-production and actual production, live production accounts for a couple of film companies. But I worked as a film auditor for a long time, so we dealt with the finance teams of all these massive films. But that's what you kind of do. You go into industry. I would always encourage to learn the skill as a practice, and you can look at high level, and then you go into granularity.
And to repeat on that, when I qualified as a chartered accountant, one of the people who qualified at the same time as me was a girl called Joanna Birkinshaw, and you will now see her name quite repeatedly on the BBC credits at the end as executive producer or line producer, because she learned her skills bottom up in a firm of accountants, and then decided she was quite sort of an out there sort of trendy sort of girl, and she decided that was her particular sphere. But even film production and the BBC need accountants. Even a zoo needs an accountant. Even an ice cream van outside needs an accountant.
You have that qualification, you're guaranteeing yourself a certain level of income. And for me, you can go into anything. CEOs, to have that financial knowledge, where you look at a set of accounts and you can look for the important things. When you're not an accountant for so long, you kind of forget certain things, but you'll know what you need to look at, and then you'll look to your management accounts team for more details on it. But to have a financial background and basis, I think it's crucial.
Well, more than 70% of the CEOs of FTSE 500 companies have an accountancy qualification.
And it makes sense.
It's encouraging, isn't it?
Yeah, well, how can you be sitting around a boardroom table making key decisions to support the lives and welfare of 100,000 people, maybe, if you don't know the financial consequences of what you're deciding? Now, there's always a legal connotation, there's always a legal aspect to that, and there's often sort of an HRE people type thing, which is why your average board of directors will have a CEO who's ultimately cock on the block, makes the final decision, a CFO, everything financial, and a COO, an operations director, who is responsible for everything else.
It's the person that everyone thinks of the accountant as the boring bean counter, but that's changed. It is now, it's a fun environment. It's, you're encouraged to speak to people. You get to know your clients. So it definitely has changed.
The reason why an accountancy qualification and studying it and having that discipline is useful is every business needs it. And before I decided to go that route, someone once described accountants as business doctors, and that's a very good way of looking at it. Because if a business is in trouble, you need to fix it. If a business is doing well, you need to do it better. So being able to look at the key moving parts, as Mark said, the working capital, the debtors, the creditors, the stock, the cash balance, and see how they all interact is basically what your accountant, who's a good accountant, can do for you.
Of course, and with the clients we've got here, you work in so many different sectors, so they are learning, they might never have thought about films. But now we've got a couple of film production companies. They're now working on sets. We had one guy that was based on a set for a few days. It might be something he wants to go into, because you've got so much exposure to different industries. It does develop you as a.
We both grew up, didn't we? Going and auditing and looking at lots and lots of different businesses over your 3 or 4 years that you were qualifying, and you would be offered probably once every 3 months, if not more often, a job in that client company, because you've come from outside, you've audited it, you've seen what makes it tick, and they're going, well, actually, why don't we offer them a job? They can come and be a financial controller or whatever.
Happen all the time.
You used to get offered jobs, I would say, probably at least once a quarter.
Yeah.
And a lot of people would take up those offers, because if you look at a partnership, most firms of accountancies are partnerships rather than limited companies. They're now sort of LLPs, which is limited liability partnership, which is trying to have your cake and eat it. But ultimately, a limited liability partnership is just that. And there's only going to be one managing partner and 2 or 3 senior partners, and even in PwC, it's going to be like that. So they're bringing in 100 trainees a year, but there's only room for one of them in 15 years' time. So it doesn't do anyone any harm to just wander off and do whatever floats your boat. If I was offered jobs at lighting companies, shipping companies, asset management companies,
Yeah, honestly, all the time.
solicitor
Big
firms.
responsibility, like I imagine, no way. Because you're.
Well, it depends what you want to do. If you want to, I was always thinking, right, I've decided to become an accountant, therefore I want to get the qualification. And at that point, I've decided if I want to stay within the profession or get off and do something else. As it happened, I ended up working for a bank. So I qualified as a chartered accountant, and then all of a sudden American banks were coming over to the UK. They wanted qualified accountants because they just had an insatiable appetite for more bookkeepers, and I joined a bank. Now I could have joined anything, but I asked my grandma what I should do, and she said go for the one that pays you the most. So I went and joined a bank. A lot of clients do try to convince each other and themselves that everyone that works for them is a contractor rather than an employee. The main reason being it's cheaper to employ a consultant or a contractor than it is to have a member of staff. The main reason we just touched on, that you have to provide things like holidays, which is 4 or 5 weeks of the year, which you get no productivity, but you still have to pay someone. National insurance that you have to pay. So on top of paying someone 100, you have to pay another 12 or 13 quid just to employ them. So it's more expensive to employ someone than it is to have a subcontractor or a consultant.
If they got found that they were actually employee, it would be the contractor that was liable for it, for the additional tax. And then they changed it that the employer. So let's say Google, for example. So now Google makes sure that they fill in these questionnaires. HMRC built this questionnaire system to make sure that that subcontractor is actually a contractor rather than an employee.
So why would you choose to employ someone
To employ them,
on a PAYE scheme?
probably because you think they're going to add more to your business than they cost you. I mean, why do we have staff, right? The main reason me and Mark started it together, and we were doing everything ourselves. Now we could have just carried on like that and become, a little bit richer and a little bit better, but it would have been, we couldn't have grown. The main reason you take on staff is because it enables you to expand and grow faster. Now
and the law will force you to make them employees. In your line of work, right, in production, they have a thing called LP10, which means if you go over 10 days on a set or a production, you are an employee, and you should be taxed as an employee and get your P45 and P60s and all them kind of things. So the law has now changed it. I would imagine, and it's changed because of Google and Microsoft, because they took on so many contractors because they didn't want the commitment of having that member of staff.
And
so
banks
were
the same. Banks were the same. I mean, at one point there was 1 in 3 people employed at Credit Suisse was a contractor and was not an employee, because 1, it was cheaper that way, and 2, it enabled them to hire and fire almost without fear, really, because if they have a recession and a downturn, they could instantly get rid of a third of their cost, because most people's biggest cost is their people cost. Typically our cost at Cubed, it's probably fair to say 2/3 of our costs are staff costs. The other third is rent and rates and light and heat and software and stuff like that. So the reason that you would choose not to have someone as an employee is because it's cheaper, and 2, you may not be certain that you want to employ that person. Now, often when you have someone on a consultancy basis or a contractor basis, you see them up close and personal, and you see what they are capable of, and you might think, they are really good, and I would like to have them fully engaged. Therefore, that will be another good reason to employ someone, because you think they're going to, as I said earlier, add more than they cost you. Now, we have the ability to sell and grow now that we've got staff. We couldn't have got to where we are today without staff, right? We'd have struggled. We probably could have done, but it would have been back-breaking. We wouldn't have been able to have time off to go and wander in the jungle or other things. Have babies.